Okay. So today we are going to look at value-based management. Value-based management. What do you mean by value-based management? Value-based management is a management accounting technique where the performance of management is assessed based on the actual value management have added to the company in a given year, in a given accounting year. For performance management, generally, for instance, traditionally, we can measure performance based on return on investments. We have return on investment. You can measure performance based on, I can measure performance based on return on capital employed. We can measure performance based on return on equity. All these are performance measurement approaches or methods. But all these methods here, they have some problems that make them not to be realistic. And what's that problem? The problem is the fact that the variables we use to compute all this include what we call non-cash items. Okay? They include what? Non-cash items. For instance, if you want to compute your return on investment is profit before interest and tax over your total investment. As you can see, if we are computing our profit before interest and tax, various elements are included in profit before interest and tax that do not involve movement of cash. For instance, revaluation is there, impairment is there, provision is there. All those things are already embedded in your profit. Now, if you are in their performance, because they can manipulate the financial statement through all these items that are not cash in nature. So, because of these shortcomings, a more modern performance measurement approach was now devised, and that is what we refer to as value-based management. Instead of having to measure your performance based on the profit you give me, I'm not interested in the profit you generate. I'm interested in the value you have added to the company. Value addition will come from increase in share price. Okay, value addition will come from increase in share price. Profitability does not necessarily reflect increase in share price. It's when you add value to the organization that the share price will increase. So instead of us measure the performance of the managers based on profit, we look for a more modern approach, and that is the value-based management. Now, the value-based management basically involves two basic computations. Okay? The value-based management involves two computations, basically, which is the economic value added and the market value added. Economic value added and market value added. Now, like I discussed earlier, all this one here, the method of measuring performance, I've discussed all those ones, okay, like cash flow, return on investment, all those things. But the one we now want to do that is modern is what? The economic value added and the market value added. What do you mean by economic value added? Economic value added simply means that the company has been able to create in a particular accounting year or the reporting period. It's sort of
Sir, your network is breaking.
Economic value added.
Sir,
So
your network
economic value added is an objective way of measuring management. Sorry about that. Can you hear me now?
Yes, sir.
Okay. I said the economic value added is an objective way of measuring performance. It's a very objective way of measuring performance in the sense that if we are measuring the performance of the managers based on economic value added, there's no way the managers can manipulate your profit. They cannot window dress your account. Okay? Now we're going to see the reason why the accountant will not be able to window dress the account if you are using economic value added. Now, the economic value added is computed as, let's go see the formula. This is the formula for economic value added. Economic value added is computed as net operating profit after tax, NOPAT, minus weighted average cost of capital times capital employed. So NOPAT minus WACC times capital employed. That is the formula for economic value added. What does it mean? NOPAT is net operating profit after tax. Now, this net operating profit after tax is different from your normal profit after tax, because before you arrive at your net operating profit after tax, you must have done some adjustment to your normal profit. Okay. Now, when you get your net operating profit after tax, you compute your weighted average cost of capital. Then you multiply by the amount of capital that you have used to generate this income or to generate this profit. So, removing the portion of capital consumption from the net operating profit after tax will give you the economic value added. Now, what is the reason for this? For instance, let me go and show you this in the Word document. Let me say, in a given year, my manager reported that they made NOPAT of 10 million. Before you can make 10 million profit, you must use capital, Nabi. You must use some resources for you to earn an income. You cannot get income without using some resources. So, Eva is saying that if you get NOPAT in a year, then the amount of capital you use to generate that income must be removed from that income. So let's say in that year, my capital employed measured as total asset, my total asset is, let me say 20 million. My total asset is 20 million. Now, of course, for me to get this 10 million, I cannot use all the 20 million to get it. It means I will have used part of this asset to get this income. So I will need to measure what amount of the total asset here have I consumed before I could get this 10 million naira. So how will I get the part of the asset consumed? I will get my WACC. Let us say my WACC is 10%. If my WACC is 10%, so my asset consumption will be what? Will be this 20 million times 10%. 20 million times 10% is what? Is 2 million. 2 million. So I will say, okay, you use 2 million asset to get 10 million profit. Therefore, in this year, the value you have added to my company is 10 million minus 2 million, which is what? Which is 8 million. This is how we compute ever in a simple way. Okay? That 8 million is the ever, is the economic value added. Is the economic value added. Okay. Now,
Sir,
let's go back. Yeah.
that 2 million, what does it
Yeah.
represent?
The 2 million represent part of this asset you consumed. The portion of your asset that you consumed. Maybe you use asset to generate profit.
Yes, sir.
Okay. When you use, okay, for instance, you are working and earning salary, Abi?
Yes, sir.
Now, you drive to the office, through of us.
Yes, sir.
From the salary you generated, the car you are using, is it not depreciating?
It's
Let's say
depreciating.
the car. So the portion of the asset of your car that maybe the asset, the car is worth, let me say 10 million, and you have used it for 1 year. Can you sell it for 1 year for 10 million again? Maybe you sell it for 9 million. Yes, Abi.
Okay.
So it means that 1 million there is what you have used, for instance,
For that
the
year.
salary you are paid for. So your salary, if your salary is 20 million naira per annum, you are not earning 20 million, because before you get that 10 million, you have incurred transport fare, isn't it?
Yes,
And if
sir.
you drive your car will have depreciated. So the depreciation of your asset of your car should be removed from your salary. That is the net you are earning.
Okay.
That's what this 2,000 represent. The asset you have used to get
Use
this.
that year to
Do you
get
understand?
yes, sir.
To get that profit. What you have consumed to get that profit is this 2 million. So it means the actual amount you have earned that year's worth is just 8 million.
8
Do you
million.
understand it now?
Yes, sir.
That is the concept of economic value added. That's the concept of economic value added. Okay. Now,
Thank you, sir.
practically, what do you say?
No, I said thank you, sir.
You're welcome. Now, let's now see how to compute ever. How do we compute ever? Some adjustment you need to pass before you can compute ever. If they give you profit before interest and tax, for instance, in the question, what you have is profit before interest and tax. You must adjust the profit before interest and tax before you can get your net operating profit after tax. And also, your capital employed will have to be adjusted for some elements for you to get the capital employed you are going to use. Now, what are these adjustments? So, these are the adjustments you need to make. Adjustment to capital employed. You coming? Okay. Now, this adjustment is not only to capital employed, it's adjustment to both, though I will be explaining that now. It's not only to capital employed, it's adjustment to both NOPAT and capital employed. And I'm going to show you how you pass the adjustment. Now, the major aim of EVA is that we want to prevent management. We want to prevent directors. We want to prevent accountants from manipulating profit. Do you understand? We want to prevent our accountant from manipulating profit. For instance, if I'm managing your company for you, I am your manager, I will tell you that if I am able to get a profit of 10 million naira in 1 year, you will give me 10% of the profit. What do you think I will do? I will do anything that is possible for me to make sure that I generate profit of 10 million. Abi, whether legal or legal, whether legitimate or illegitimate, I will make sure that I make that 10 million naira because I know that my bonus is tied to the 10 million naira profit. So because of that, where I need to make provision for some expenses, I may not make provision. Where I need to buy an asset, I may not buy the asset because I know that if I buy the asset, I'm going to incur a higher depreciation. When an asset is new, depreciation on the asset will be high. So if my aim is to increase my profit, I will not buy the asset. If my aim is to increase profit, I will not make provision for bad debt. The moment I don't make this provision, my profit will go up. And don't forget, profit is not cash. If you want me to make profit, then I will make profit. But how do I want to make that profit? I will make the profit in a way that will affect the long-term success of the organization, because my aim is to get short-term return. So whatever I want to do, whatever I want to achieve is that we want to block all the avenues through which managers can manipulate profit. We want to block all those ways, all those routes that managers can take to manipulate profit. We want to block them. Now, what are the ways? Number one, expenditure on research and development, staff training, advertising. Now, let's take these three. Expenditure on research and development, staff training, and advertising. Let me come and explain that here. We have R&D, expenditure on R&D. Where is this mosquito? Okay. Expenditure on R&D, staff what? Staff training, and advertising. Expenditure on R&D, staff training, and advertising. Now, what standard deal with this? What accounting standard deal with R&D? Can you tell me? What accounting standard deal with R&D? Are you there?
Yes, sir.
So what accounting standard deals with R&D?
I can't remember. I
don't
can't
say
remember again. Yes, sir.
Why won't you remember accounting standard? Even though you don't know the provision of that standard. You remember the standard, even though you don't know the provision. Mrs. Shem, you're welcome. Mrs. Shem, are you with us? Are you with us now? Mrs. Shem, are you with us now? Hello? Okay, you're not yet with us. Now, the standard that deals with R&D is IAS 38.
Okay.
Intangible assets.
Okay.
Intangible assets. That is the standard that deals with it. Now, IAS 38 that will make you to capitalize intangible assets such as R&D. Okay, there are conditions in IAS 38 that your intangible asset must meet before you can capitalize it. You know the meaning of capitalization, Abby? Do you know?
Yes, sir.
And what's the meaning of capitalization?
Before capital, that's I don't know how to explain it again.
Mrs. Shea, are you there? Mrs. Oluwaseun. Hello.
Good evening, sir.
Good evening. I want to welcome you with a question now. When we say we capitalize an item, what does it mean?
I think it means.
Don't think. When we are professional,
To
we are telling you
recognize cash as asset or something. Other than expenses.
When you capitalize an item, it simply means that you are treating that item as a non-current asset. You are what? You are showing it on the face of your statement of financial position as a non-current asset. That's what we mean by capitalize. When you capitalize an expense, that expense becomes a non-current asset that should be reflected on the face of your statement of financial position. Do you understand now?
Yes, sir.
Now, before you can treat research and development as a non-current asset, rather than treating it as an expense, certain conditions must be met. If those conditions are not met, the expenditure on the research and development must be expensed. That is, you have to treat it as an expense if those conditions are not met. Do you understand? But if the expense may meet the conditions, then you will not expense it. Rather, you will show it as a non-current asset in the statement of financial position. Did you understand that? Hello, I'm giving you the background to IAS 38 first. I've not started eval. That is the requirement of IAS 38. Now, let us assume that I manage your company for you. And we incur research and development expenditure that amounts to 20 million naira. And this expenditure does not meet the requirement of IAS 38. How should I treat this expense? How should I treat the expenditure?
That means you expect it to not be in the statement
So
of financial position.
we have said it now, just one word. That means I should expense it.
Expense it.
That, that means I must expense because it does not meet the requirement. Abi?
Okay.
But if I expense it, what will happen to my profit? My profit will drop by 20 million, Abi?
Yes.
But my aim is that I want to meet a profit target so that I will get my bonus. Do you think I'll be willing to expend that amount?
No.
No, I will not be willing because I know that if I should expense 20 million, my profit will drop by 20 million. And I am one of the management of the organization, and our bonus is tied to the amount of profit we make during that year. So what I will do is that I just say, okay, even though I know that this expenditure does not meet the requirement of IS 38, I will tell you that this expenditure meets the requirement. And the moment, the fact that an expenditure meets the requirement or not is a judgment of the management. It's not the ICANN president that will come and tell you that, oh, this expenditure should be expensed or not. No, it's management judgment. Okay, management judgment that was okay. No, at this stage of this expenditure, it meets the requirement of IS 38. So even though we know that it does not meet it, we will not like to expense it. So we go and capitalize it, Abi. It
Yes,
means we are already window dressing our account. We are already manipulating our profit. Do you understand?
Yes,
And that is what Eva does not want. That is what Eva does not want. So Eva now say, okay, come. If you have a research and development expenditure, if you have a research and development expenditure, whether it meets the requirement of IAS 38 or it does not meet the requirement, you must capitalize it. Do you understand now?
okay.
So it means Eva does not obey the rule of accounting standard. Take note. Eva does not obey the rule of accounting standard.
Okay.
Do you understand?
Yes, sir.
So if you see research and development and you are doing Eva, you don't to start saying, what does IS 38 says about this? No. You don't have to make reference to IS 38. You have to capitalize it, whether it meets the requirement for capitalization or not. Do you understand?
Yes, sir.
Now, if the company has already treated this as an expense before, then you will go and add it back to profit and what? And also add it back to capital employed. Let me come and show you this. In my profit or loss, I already have in my P or L, I already have research and development expense. And I've put 20 million there of capitalization or not. I have to capitalize, Abi. But here, have I capitalized it here? No. What did I do? I expense it, Abi.
Yes, sir.
So I have to remove it from my expenses and take it back to assets. If it has been treated as an expense, then you go and what? Add it back. You go and add it back. Here it will have been deducted as a negative. It will have been deducted as a negative figure. Then here we now add it back to remove it from expenses to add it back so that you now have what? The balance will be zero. Neutralize what you did earlier. You have reversed it. Now, after reversing, what's the next thing you do? You now go and capitalize it. You know you have removed it from expense, Abby. Since you have removed it to expense from expense, then you now need to go and capitalize it. Capitalizing it now means that you will now go and recognize intangible assets. You will recognize intangible assets. You go and recognize intangible assets. You now say intangible asset. You debit it, debit it with 20 million naira. And what? You credit your cash or bank. Cash or bank with what? You credit it with 20 million naira. You have capitalized that expense. Please look at this. Did you understand this? Mrs. Shea, are you with us?
Partially, sir.
What are you doing that is making it to be partially?
I'm actually listening, but I'm trying to.
You haven't missed anything. This is the first concept I'm explaining ever.
What was ever, sir?
Is that?
What was ever?
Economy value added.
Oh, okay. Continue, sir.
This is the first treatment. This is the first treatment I will explain.
Okay.
Okay. Now, that is the treatment for research and development. Also, for staff training, when you train your staff, IAS 38 does not permit you, okay? Capitalization not permitted. IAS 38 does not permit you to capitalize your the amount you spend in training your staff. You have spent 20 billion to train your staff. You have spent 50 million to train your staff. IAS 38 does not permit any company to recognize assets in respect of the amount spent on training staff. Do you understand? Why? Because one of the requirements for you to recognize an asset is that the entity must have control over the asset. There must be what? There must be control over the asset. But do you have control over your employee? Answer that question. Do you have control over your employee? No. The answer is no. If you have someone you employ today and the person says, I'm leaving, you can't stop him from leaving now. So if you have spent 10 million to develop that person, you have spent 10 million to train him, and you have recorded, what happens? That's why IAS 38 says, okay, money spent on training and developing your staff should not be capitalized. But like I said earlier, forever does not obey accounting standard rule, okay? IFRS. Ever does not obey the rule. So ever is saying that staff and development cost should be capitalized, because there is the opposite of what? IS-38, Abi. So when you spend money, the reason why ever is saying that is that when you spend money on your staff, the benefit is expected to last for a longer time. Now, management can use this to manipulate profit. If my aim is to reduce my profit, for instance, I can reduce my profit by recognizing staff training as an expense. So because of that, ever I say anything that will affect your profit, any means through which management can manipulate profit, we don't want it. So staff training cost should not be recognized as an expense. Rather, it should be capitalized. So if it has been treated as an expense before, the same treatment you did to research and development is what I'm going to do. You will add it back, then you go and recognize intangible assets. The same treatment for advertising expenditure. So that's note 1 there. Expenditure on research and development, staff training, advertising, here treated as expenses rather. In the statement of profit or loss should be added back to NOPAT and also to capital employed. Who did not understand this? I've spent more than 15 minutes to explain just one point. This is why I'm explaining this is that I want you to understand the concept of EVA. If you understand the concept of EVA, then you can solve any question on EVA, because the adjustment you need to pass to EVA is just like 5 or 6 adjustments. The moment you understand those adjustments, then you are good to go as far as EVA is concerned. Let's go to the second point. The expenditure mentioned in 1 above should be amortized over a number of years. The amount so amortized should be deducted from capital employed to reflect loss in economic value during the period, just like your depreciation. Okay, you compute amortization because you have capitalized and it is an intangible asset. Then you need to compute amortization. Amortization will now be used to reduce what do you call it? The capital employed in respect of that asset. So that is simple to explain anyway. It's not complex. Number 3, provisions, allowances, deferred tax reserve in the balance sheet should be added back to NOPAT. Now, you know, provision does not involve movement of cash. Neither is allowances and deferred taxes. They do not involve movement of cash. There are provisions, provision for bad debt, provision for deferred tax, provision for allowances. You understand? All these are non-cash items. So they will have been treated as an expense in the income statement and will have been used to reduce, for instance, if it is provision for bad debt, provision for bad debt will have been increased, will have been used to reduce profit, and the total will have been used to reduce receivable in your statement of financial position. So what will you do? You will add the one you deducted from profit, you will add it back, and the one you deducted from receivable, you also add it back. Okay, now. So it means provision is not allowed. Provision is not allowed when computing EVA. Provision is not allowed when computing EVA. That's what it means. So where you have recognized provision before, you need to reverse it. Where you have recognized provision, you need to reverse it. Okay. Next is the treatment of finance lease and operating lease. Now, for finance lease is treated as you capitalize it. You capitalize finance lease as though you are the owner of the asset. I believe we all know what is lease. So when you have finance lease, IS 17 before anyway, before it used to be IS 17 that deal with leases. Now is IFRS 16. We now have IFRS 16 that deals with leases. So in the old IS 17 leases, we have distinction between operating lease and finance lease. Finance lease is treated as though the lessee is the owner of the asset. It means when I take an asset on finance lease basis, I'm going to capitalize the asset and depreciate it accordingly. But if it is operating lease, I am not the owner of the asset, so I cannot capitalize. So EVA is now saying when you take a lease, whether it is an operating lease or a finance lease, you must capitalize. Can you see that? Whether it is finance lease or operating lease, you must capitalize it. So if you have operating lease, an asset that has been treated based on operating lease, you must reverse the treatment and give it the treatment of finance lease. That is adjustment number 4. Then we have adjustment number 5, which is non-cash expenses. Non-cash expenses basically deals with items like impairments, depreciation, amortization, all those things. Now, the requirement is that when you have non-cash like depreciation, you are not allowed to remove it from your profit because depreciation is a non-cash item. So if you have depreciation or other non-cash item, in the question you can have depreciation separate and they give you other non-cash items separate, no problem. It's the same treatment. Go and add it back to profit. Now, in place of depreciation, you now have economic depreciation. You are not to compute economic depreciation. Economic depreciation will be given to you in the question. So you will add back depreciation and deduct what? And deduct economic depreciation. So it simply means you are adding back accounting depreciation, you are removing economic depreciation.
Sir,
okay? Yeah.
what's the difference between the economic depreciation and the main depreciation?
Just like you have it in your capital allowance and depreciation. Same thing.
Huh?
You know capital allowance now?
Yes, sir.
So when you do your tax computation, what do? You add back depreciation and you do capital allowance. So capital allowance is the same thing with what economic depreciation is.
Okay.
But
Sir.
you are not to compute it, to be given to you in the question.
Okay, sir.
You don't have to bother about the computation. Do you understand? Shall we continue?
Yes, sir.
Hello? Can you hear me?
Sir. Yes, sir.
Yes, sir. Continue, sir.
Okay. Now, the last adjustment is your tax. How do you compute your tax? Now, your tax will be computed. Don't worry, all this thing that look like story. By the time we solve question now, you understand it better. Okay? You understand it better. Don't worry. Now, our tax is computed as this. The tax you have in the income statement given to you is not the tax you are going to use. No. You have to go and do workings for your tax. And the working we are going to do is that you will take the tax in the income statement if there is no any other one in additional information. If you have tax in the additional information, you use the one in the additional information. But if there is no, you use the tax in the income statement. You will now adjust it. If there is increase in deferred tax, you will remove it. The question will let you know if there is increase in deferred tax or decrease. If there is increase in deferred tax, you will remove it from the tax. If there is a decrease, you add it to it. Then the interest you initially deducted in your income statement, you get the interest you multiply by what? By your tax rate. That will be, you add it back. That is, you will get the amount of interest you pay during the year, multiply by the tax rate, you get your interest. So you get your tax on interest, you add it back. So the addition of these three will give you you will take to the low part. Okay. Now, what are the benefits of EVA? EVA assess performance of a company. I made through the idea that what business is only profitable when they create wealth to shareholders. That's it. EVA does not measure success. EVA does not measure success based on profit. No. If you like make 500 billion, EVA will not recognize your company as being successful until the company is assessed based on the value they are able to create to shareholders. And the value is going to be reflected in the share price as quoted on the stock market. Now, let me quickly confirm something. Mrs. Sheung, do you have outstanding video? Hello?
Hello, sir.
Do we have outstanding video that I've not sent?
I don't think so.
Have I sent the one we did on Friday? I think the answer should be yes. I think I sent that video on Saturday.
It was the Thursday one that you sent on Friday.
October 1 was Friday, I mean.
The Thursday one. Friday was 1st of October.
Okay, I think I understand you now. Okay. That's the 1st of, I will go and say 1st of October. 1st of October. You can go and look for it. Now, that is one benefit of EVA. EVA will assess your company based on the value the company has created to shareholders, not on the basis of profit generated by the company. No. So, a performance measurement based on EVA is a true performance measurement, unlike a performance measurement based on profit. Okay. EVA as a performance indicator is very useful. The calculations show how and where a company created value through the inclusion of balance sheet items. This forces managers to be aware of assets and expenses when making managerial decisions. That's another key benefit of EVA. So you look at areas where you are adding value. So by the time managers know that, oh, performance is measured based on EVA, they will be wary of what? All their business decisions, they'll be wary of expenses and even the asset of the company, because they know that there is no way they can manipulate their success. Other benefits of EVA. Other benefits of EVA include an EVA financial management system remove all inconsistencies resulting from the use of different financial measures for different corporate functions. Okay? When we are measuring performance based on profit, there are a lot of inconsistencies. So using EVA will remove all those inconsistencies. Okay? It is useful to assess whether or not the firm or division create value. And it is based on cash flows. Hence, less easy to manipulate, like accounting profit. And lastly, it can easily be communicated and understood by managers and employees. These are the benefits of EVA. What are the drawbacks? The drawbacks of EVA is the fact that it is best used for companies that are stable in nature, that have stable activities. It's not that suitable for a company whose activity is fluctuating. Okay. And of course, company with intangible assets, more of intangible assets than tangible assets, will not be good for the purpose of evaluation using EVA. So, in short, it is useful for a company that has more of tangible non-current assets than intangible non-current assets. And other short back is that the calculation of EVA is very, very complex. Okay, EVA is complex and many adjustments are required. So for you to initially, the adjustment to EVA is like 164 adjustments. You can say like 164 adjustments before it is now reduced to 6, because it is thought that not all those adjustments are actually material. Not all of them are material. So, EVA is not suitable for young companies. When you have upcoming companies, infant companies, EVA is not suitable for them because those companies have not stabilized. Also, EVA is not stable for financial institutions like banks because they carry more of liabilities than assets. You understand? They carry more of liabilities than assets. These are the drawbacks of EVA. Now let's go towards market value added. Market value added is simple. When you discount your EVA using WACC, you get market value added. So discounted EVA is market value added. If your question asks you to compute market value added, then you will compute your economic value added, you discount it using WACC, you get your market value added. If you get your market value added and the question asks you to compute market value of equity, from the market value added, you will remove market value of debt. It's just like your corporate value. Market value added is corporate value, but that corporate value is computed using economic value added approach. So when you remove the market value of debt of the company from the market value added, you will get market value of equity. Okay, you will get market value of equity. Now, another way of computing market value added is this formula. If you are given market value of equity at the beginning, market value of equity at the end, and what? And the book value of equity at the beginning, book value of equity at the end. Sorry, book value of debt at the beginning. Now, when you remove the book value of equity and debt at the end from the book value of equity, sorry, from the market value of equity and market value of debt at the end, you get your economic value added. please, you have to correct this. It's not supposed to be book value. Is look at the market value of equity at the end. Market value, please, are you correcting it? I want to correct that formula. That formula is wrong. The formula is wrong. Market value of equity at the end, market plus market value of debt at the end, minus market value of equity at the beginning, plus market value of equity, sorry, market value of debt at the end, we give you the market value added. Let me pick it again. Market value of equity at the end, plus market value of debt at the end, minus market value of equity at the beginning, minus market value, sorry, plus market value of debt at the beginning. We give you your market value added. Look at this. You can see, and what did I do? I discounted my ever using WACC. I've explained that earlier. If you want to compute market value added by equity, okay, by equity, is value of equity at the end minus value of equity at the beginning plus any amount of dividend paid during that period. That will give you the market value added by equity. So market value of equity at the end minus market value of equity at the beginning plus any dividend distributed during that period, we give you the market value of equity. So we give you the market value added by equity. These are the three ways you can compute market value added. But this is what? This is the most popular of the three. And that is the one you will likely face. This one, you may also face a situation like this. But this one is very, very simple. Market value at the end minus market value at the beginning plus dividend. We give you that market value. Now let's attempt to solve this question. Let us look at the requirements. Required. Calculate, showing all relevant workings, the economy value added for the year ended December 31, 2015. Make use of the adjusted opening capital employed. Comment on your results and make appropriate recommendations. B, irrespective of your answer in A above, assume the company's current EVA is 120 million and that this will decline annually by 2% for the next 10 years and then increase by 4% per annum in perpetuity. Assume the following for this part only. Cost of equity, 40%, WACC, 10%. Calculate the market value MV by the company. Show Jack Limited. Let's go and read it. Jack Limited. Jack Limited is a family-owned business which has grown strongly in the last 50 years. The key objective of the company is to maximize the family's wealth through their shareholding. Recently, the directors introduced value-based management using economic value added, EVA, as the index for measuring performance. You are provided with the following financial information: statement of profit or loss and other comprehensive income for the year ended December 31, 2015. Operating profit, finance charges, profit before tax, tax at 25%, profit after tax. Then we have notes. Let's see the note. Note 1. Capital employed from the statement of financial position 2015, 2014. Now, let me explain this. I'm computing never for which year? I'm computing never for the year ended 31 December 2015. Now, this profit here, this profit after tax here, the capital I use to generate this profit is capital as at when? Who can answer that question? Is capital as at when? The capital I use to get this profit on this date is capital as at when? I want that question answered. Is capital as at what date? That's what I mean. Capital as at what date?
(2015).
As at 2015. Okay. If you are doing a business, (31st December 2015 is your year end, and you made a profit of 20 million naira on that date. So the money you used to do that business, did you put the money in the business on this date?
Okay, to be carried over. It will be carried forward to 2016.
No, it's from 2014.
Yeah. So 2014 now, it's a very simple logic. If I want to do business, I have to put the money I will use for my business, I need to put it in the business at the beginning of the year. Sorry, I open this one. So the profit I made in 2015, 34 December, the money I used to make that profit is not the money on that same date now. I have used that money for 12 months before I can make this profit at the end of the year. So the capital I use is the capital as at the end of 2014, because the capital as at the end of 2014 is the capital at the beginning of 2015. Do you understand? The capital at the end of 2015 will be the capital at the beginning of 2015. So it is that capital of that year is the capital at the beginning of that period. And invariably, that is the capital at the end of 2014. That's clear, Abby. So what am I trying to say? Computing. Hello.
Hello, sir. Network is breaking.
Can you hear me now?
Yes, sir.
Okay, let me see whether I can. Let me switch the network to. Let me switch network. Okay, let me try this one. Let me try B2. Okay, can you hear me now?
Yes, sir.
Right. So let's see whether this one will be better. So operating cost, depreciation, provision for doubtful debts, research and development, other non-cash cash expenses, marketing expenses. Okay. Economic depreciation is assessed to be 415 million, this in million, in 2015. Economic depreciation include any appropriate amortization adjustment in previous year. It can be assumed that economic and accounting depreciation were the same. We use that information when we get there. Tax is the cash paid in the current year, which is 45 million. You can see what I told you about. That if they give you tax in the additional information, that's the one we are going to start with. So I will not start with this tax again. This is what I will have started with, this one here. But because I've been given another tax in additional information, I will start with the one in the additional information. And an adjustment of 2.5 million for deferred tax provisions. There was no deferred tax balance prior to 2015. So no deferred tax before, but now we have deferred tax of 2.5. That is already an increase. I mean, that's an increase because before now, we don't have deferred tax, but now we are having 2.5. So deferred tax has increased from 0 to what? To 2.5. So I'm having an increase in deferred tax. The provision for doubtful debt was 22.5 million on the 2015 statement of financial position. Research and development cost is not capitalized in the account. It relates to a new project that will be developed over 5 years and is expected to be of long-term benefit to the company. The first year of this project is 2015. That's information on research and development. The company has been spending heavily on marketing each year to build its brand long-term. Estimated cost of capital of the company is equity 16%, debt pre-tax 5%. Gearing, debt to equity ratio 1.5 to 1. So calculate, show the relevant workings, the economic value added. So let's see how we approach this question. Example, let me call it economic value added. Economic value added. That's ever. Let's example what? Ever is example what? Example 4.
Example 4. Jack Limited.
Example 4, Jack Limited. So, requirement A, we want to compute economic value added. Ever. And to compute ever. So ever is what? Ever is computed as net operating profit after tax minus WACC times capital employed. Put this formula down first so that you are guided. That will guide you to know what you want to do. Net operating profit after tax slash WACC minus WACC over capital employed. Now, let me get my notepad here and let me come and do my capital employed down. Capital employed. My capital employed is as at 31st December 2014. But my notepad is for the year ended 31 December 2015. Okay. We are working in thousand or million. Let me check. Millions. So we are working in millions. We are working in millions. So I will have profit. You always start with profit before interest and tax. Please take note. Profit before interest and tax. Profit before interest and tax. And what is the profit before interest and tax? Profit before interest and tax is 340. That's operating profit. So 340. Next. The next thing now is that I will go to the additional notes I've given here and now start making my adjustment one by one. Operating cost, we have depreciation. Depreciation is what? 295 ARB for 2015. So I will go to 2015, add back accounting depreciation, add back accounting depreciation. What do I call it? $295.00. Now, and I told you that when you add back accounting depreciation, there must be economic depreciation. So now go and search for it. Are you given economic depreciation? Now look at it. Note 3. Note 3. Note 3. Economic depreciation is assessed to be 450 million in 2015. So I'll come here, I will remove less economic depreciation. It's just like your capital allowance. Add back depreciation, deduct capital allowance. So the same thing we are doing here, no difference. 415.00. The same thing we are doing here, the same concept. Now, you now go and check for 2014 because we also need to adjust capital employed. Don't forget. We are adding it back to capital employed. But look at it. This one is for 2015, Abby. You cannot go and add this one to 2014 now because this is not for 2014. Anything you are going to add to 2014 must relate to 2014 figure. So here now, I will come and put my capital employed here. I'm working in million. Capital employed. What is the capital employed here? In 2014, capital employed is 6185. Can see that? You can see that I did not pick capital employed for 2015. Which one am I picking? 2014, previous year. So I picked that 6185. 6,185. 6,185. Now, do I have the depreciation to add back? Let's go and see. The grant says that, note 3, it can be assumed that economic and accounting depreciation were the same. In previous years, it can be assumed that economic and accounting depreciation were the same. What is the accounting depreciation here? 285. Abi? Sorry. Yeah, 285 in 2014. But the question has told me that in this year, both economic depreciation and accounting depreciation are the same. So if I come here now, if I say add back accounting depreciation, that will be 285, right? 285. I will come again and say less economic depreciation, 285. Have I not succeeded in wasting my time? So, in your opinion, have I not succeeded in wasting my time, in your opinion? Are you there? Are you with me?
Yes,
Hello?
sir. Yes,
Have
sir.
I not wasted my time? I have. Because economic depreciation and accounting depreciation are the same. Why don't I ignore the two? Because they are the same. The net effect will still be 0. I added about 28, 285. I removed 285. Have I added back anything? No.
It's
You see
because
that-
is there a situation whereby it will be different?
Yes, now.
Okay. But because the
It's
question
different
said
here.
that.
Is it not different here?
Oh, okay.
It's different there now. So if it is different, you treat it. If they are the same, you ignore. Do you understand?
Okay.
The
In
reason why-
2014, they are the same. In 2015, they are different.
Exactly. Is it clear?
Yes, sir.
Right. Let us continue. Now, provision for doubtful debts. Now, where will you find operating costs? Is it in balance sheet or statement or profit or loss?
Profit or loss.
Okay. Now, it therefore means that this provision for doubtful debt here, this one has been charged to profit or loss, Abi? And because it is under cost, it means it is an increase in provision. It is an increase in provision for doubtful debt. When there is an increase in provision for doubtful debt, you remove it from your profit. If it is an increase, you treat it as other income. So because this one is found under expense now, is what? Is an expense that has been deducted, and we add it back, which is 10. So add back provision for doubtful debt. Provision for doubtful. Where is spelled out? I don't know spelling again. That is 10, Abi. So 10.00. 10.00. 10.00. Now, in this year, 2014, we have provision for doubtful debt, Abi. But this 2.5, where was it charged to? Is it balance sheet? Let us respond now.
Come again, sir. Sorry, sir.
This 2.5 here, where was it charged to? Where is it right now? Where is it?
That's statement of financial position.
When you see operating cost, this operating cost now, look at it, this operating cost. How will this be in statement of financial position?
Okay.
This was charged to income statement. So you have to go and look for the one that was charged to what? That was charged to statement of financial position. How will I get that? I will come to the additional information given to me here. Information 5. The provision for doubtful debt was 22.5 million. Are you there? The provision for doubtful debt was 22.5 million on the 2015 statement of financial position. Now look at it. Look at it. Let me go and show you this. Let me say balance sheet. Balance sheet 2015. We have 22.5. this is my provision. But P or L 2015, this is what I charge on it, 2.5. Why the difference? The difference is that the provision that goes to P or L is the increase or decrease in provision. But the one that goes to the balance sheet is the total provision. The one that goes to balance sheet is total provision. But the one that you recognize in income statement is the decrease or increase. Now, for me to have 2.5 as an expense in the statement of financial position, in my profit or loss, it means my provision has increased. Okay, it means my provision has increased. Therefore, I will remove the increase from the total. If I remove the increase from the total, it means it will be 22.5 minus what? Minus 2.5. So this is at the end of the year. This is year end. This one is year end. So which one is at the beginning? The one that is at the beginning is, so at the beginning, that is balance sheet. The one that is in the balance sheet at the beginning. So at the beginning, the one we have there is just 20.5, I'm not mistaken, 20.5. This one we have at the beginning. Let's go and check it. Let's go and check it. Look at it. Oh, okay. The one which, okay, okay, good. Oh, okay, not 10, no, it's not 2.5, is 10. Sorry, I was picking 2014 figure. This one is 10 now, Abby. This one is 10. For 2015 is 10. So the one I charged to POL is 10 in 2015, not 2.5. So it means at the beginning, my provision is 12.5. So this provision at the beginning is a provision at the end of 2014. This is a provision at the end of 2014. Do you understand it now? So the one you have at the end of 2015, remove increase during the period from it. The balance is the balance at the beginning of the year. And the balance at the beginning of the year 2015 is the one at the end of 2014. So it means in my 2014 figure, my provision for doubtful debt, is 12.5. 12.5. That's my provision for that year. I'll go back to the question. Research and development, they did not capitalize because you can see it is treated under expense, Abby. But what does EVA say? EVA says that whether it meets the requirement or not, we have to capitalize. We have to capitalize it. So this one that was deducted from expense, we add it back. And because you know it's for 2015, it's not for 2014. So I will not go and add it back to 2014. No. You can see that in 2014, there is no research and development. So nothing to be added to 2014 capital employed. So I will only add this one back to my profit in 2015. But nothing will be added to 2014 figure because in 2014, there is no R&D. So I've come here, I put my research and development up there. Research and development. Research and development, that is 60. 60.00. 60.00. 60.00. So I will go back to the question again. You can see the way I'm picking it one by one. I have other non-cash item, okay? Other non-cash, the two of them has now. The two of them have it. So I will add 35 back to profit in 2015. I will add 30 to capital employed in 2014. So 35, 30. So what do I call it? Marketing, I mean. Other non-cash item. Other non-cash item. Other non-cash items. So this is 35. So I come to capital employed, other non-cash item. I will have 30 here to be added back because that is the figure for 2014. That's the figure we have for 2014. I'll go back to the question again. Marketing expenses, 50, 45. I'll go and add them accordingly. 50 back to profit in 2015, 45 back to capital employed in 2014. So 50, 45. Let me shift this one a little up. So marketing expenses. Marketing expenses, we have 50 here. Marketing expenses, we have 45. So you can see that ever is not what is even, it's for you to know the figure that you are adding back or deduct. That's all. Now, we have treated all this now. We have treated all figures here. The next thing is to go and compute our tax. Let us go and compute our tax. Then put this one as working. Then put this one as workings. So this is working 1. So working 2. Tax. Now, as per additional information, what's the tax we have there? Additional information. The tax we have there is 45, if I'm not mistaken. The tax they give us is 45. Good. They give us 45. We're going to put the 45 there. Then we have increase in deferred tax. I've told you the reason why it is an increase. Increase in deferred tax. Because in previous year, there is no deferred tax. But this year now, we're having 2.5. So it has increased from 0 to 2.5. Then tax lost on interest. Because we are starting with profit before interest and tax. So our interest is no longer saving us tax. And we have to pick that interest and what? And charge my tax. You can see this is the profit I pick here. This profit is already including what? Tax. I mean, so if I want to compute my tax, the interest should suffer tax as well. So I pick this 115, I multiply by 25%. 115 times 25%. 115 times 0.25. That will give me what? Well, give me the figure. 115 times 0.25 will give me what? Hello?
28.75.
28.75. 28.75. 28.75. So that is my tax. Now add everything together. What do we have for tax? What do we have? 70 what?
76.25.
Oh, this is an increase in the VAT tax now. We need to deduct it.
Okay.
It's an increase in the VAT tax, you deduct. That's the principle. If it's a decrease, you add, Abby. So that should be what? 70 what?
71.25.
1.25. That is the tax you are going to deduct here. That's the tax we take to this income statement. So tax, work note 2. That's the way you sort your tax, where we are computing ever. And I'll come here, I put 71.25. 71.25. So, what is our, these are no part now. That's our net operating profit after tax. We add everything together. The tax is going to be deducted. You know, we are paying tax, Abby. Deduct the tax. We are paying it. So what do we have there? Mrs. Shio, are you with us?
Yes, sir. Yeah.
I don't know why my messages are not delivering since for the past 4 hours now.
There is issue with WhatsApp. You've not gotten that info. WhatsApp,
Okay, there is issue with WhatsApp, Abby.
yes.
I think so.
Instagram shut down for now.
I learned that the federal government want to ban the social media.
That's what we are hearing. No?
So they started, and that meaning that our WhatsApp will no longer work.
Yes, and Instagram.
Wow, they.
They don't want people to expose them.
But what is their headache with our own life? They chop the money, we don't complain. Make we no enjoy our life again. Okay. Mrs. Chiwe, I want to day government too. I love each other. I don't feel communicate with anybody now.
And this problem started this evening, this afternoon.
This afternoon,
Yes,
Telegram is working anyway.
You said?
Telegram is working.
Yes, Telegram messages are dropping on Telegram, but on
Yes.
Seriously, people are now trooping to Telegram now.
If they want to close it, we switch over to Telegram. So the answer, sir, is 298.75.
Not possible.
298.75.
Not possible.
Huh?
I don't think so.
I don't know. Plus and minus. I've done it 2 times.
Profit before interest and tax, 340 plus 295 minus 415.
$415.
Which is 415?
I got 303.75.
That's the correct answer. 303.75. This is true. You didn't do your addition very well. That is our no part.
Okay. 50.
That's our no part. And what's our capital employed? Also add this one.
Okay. 303.75. You missed something.
You mean something? I know you mean something.
Marketing
So-
expenses. Okay.
So what's our capital employed?
6,273.
6,273. Point what? 0.5, have you? We have 0.5 here now.
Yes, no, it's 6,273.72.5. So me, I approximated to
Okay.
70.
70.
Yes,
Mhm.
fine.
Now, we need to go and compute our work. Abi? I believe you are getting this, are you?
Sir, please come down. Sir, please let me see that our calculation, the net operating profit. And this one, leave it. Okay.
So I'm not writing. No, I'll need the notes immediately after the class.
Why are you not writing? How will I send the note when WhatsApp is not working?
Telegram.
Telegram. Telegram. Are you on
Chat me up.
Telegram, sir?
Chat me up on Telegram.
Okay.
Why are you not writing?
Distraction. Yeah, that's right.
These people are looking for trouble. They will see another answer if they are not careful.
Honestly. And this month is answers will be one year.
Why?
Yes. So instead of what that the Pasaka people.
Excuse me, sir.
Yeah. Are you done?
So, no, I'm a little bit confused. This calculation of under this capital employed,
Yeah.
so you said where you said add back depreciation 285, then less
Yeah.
the economic depreciation. Where is the
Mhm.
economic depreciation for this one?
For which one?
Did they give it to us?
They gave it to us now. This one, Abi.
Yes,
What?
no, under the calculation of the capital employed.
We didn't recognize it now. Did you say it like
Yes,
economic development?
yes. You said something. You said why we did not recognize it is because the 285 for this and these are the same.
Look at it. We'll go for information 3. Read this statement. Can you see?
Yeah.
Can you see the statement?
Yes, I said economic depreciation
Read it from
is
the beginning.
assessed to be
Read it from the beginning. No, for the one I highlighted.
okay. In previous year, it can be assumed that economic and accounting depreciation are the same.
And what is the economic? What is the accounting depreciation in previous year?
Okay. 285.
So
Okay.
economic depreciation will also be what?
285.
That's it.
Okay.
That's why we did not
But-
recognize it.
Okay. Thank you, sir.
Because it's two are the same. There's no point recognizing it. It's a waste
Okay,
of
sir.
time. Okay. So let's go and compute our cost of capital work. That will be note 3. Work. Work. So we are given cost of equity to be 16%, Abi. Can you see it? Cost of equity is 16%. This is 16. This one pre-tax 5, 1.55. Let me copy this one. Our cost of equity is 16%. The gearing is 1.5 debt to equity. The moment they give you ratio, don't bother yourself. Equity is 1. Okay? Over 1.5 plus 1 is 2.5. If they give you ratio, just use the ratio they give you. Don't waste your time. It's when it is a percentage that you decide to be saying, no, is it 140, is it this, is it that? But if it is ratio, they've told you debt equity ratio is 1.5 to 1. So debt is 1.5, equity is 1. So just take it that way. Plus cost of debt is 5, but it is pre-tax, Abi. So I will say 1 minus tax rate. Tax rate is 0.25. Then everything here times 1.5 over 2.5. That's 1.5 plus 1. So WACC is equal to, oh yeah. Oh yeah, do the calculation now. 16, this is 2.5. 16 over 2.5 is what? Oh yeah. Let's be fast. I'm still going forward.
6.4.
6.4%. What about the other one? The other one we do 5 times 0.75 times 1.5, then over 2.5.
$2.25.
2.25. So add the two together. What do we have as our work?
8.65. 8.65.
8.65. So let's say 8.7%. 8.7%. Abi? That is the work. Then we now go and compute our economic value added straight. So my EVA is equal to, what is the net operating profit after tax? 303.75 minus WACC. What is the WACC? 8.7% times what is the capital employed? 6,272.5. Can you see that now? Simple as that. EVA is equal to 303.75 minus, we have multiplied this by 6,272.5. What do we have?
Six two seven two times. I don't know. What
You
am
don't
I
know
getting?
what?
I don't know what I'm getting. Wait, sir. I should multiply what?
8.7% by 6,272.5.
That is 0.087. Huh?
How will you point? Yeah, 0.087. Yeah, 0.087. 0.087 times 6,272.5 is what?
6,272.5. I'm getting 545.7.
545.7.
0.707. Okay.
1. So remove it. What do we have as our EVA?
To give us negative.
Negative what?
Negative 241.96.
241.96. That's our ever. Now, if your ever is negative, it simply means that the company is not adding value. The company is reducing value, is destroying value. Shareholders' wealth is reducing. But if you look at this company, what is their profit they declare? They declare what? They declare 168.7 million profits. Abi? So if you want to assess the company based on profit, you will clap for the management, Abi, that they've done well. But look at it. When we now go and we use a better performance evaluation, we discover that management are actually killing this company, because in the long run, the share price will what? Will be declining, and that can spell doom for the organization. That is the importance of economic value added as a performance measurement method. Any question on this? So my comment will be comment. The management of Jack. The management of Jack Limited has not added value in 2015. Rather, shareholders' wealth will decline by 241.96 million. So that's the comment we are going to give. Any question before we call it a day? I don't go to my house. Mrs. Shew, you are no longer with us.
I'm here, sir.
Mrs. Shew, you are no longer with us.
Okay.
She's no longer with us. I noticed she has not been saying anything since. She has left us on our
Distractions, family distractions.
family distraction, yeah.
Nice.
Distraction, you know, in fact,
I know.
watch this thing.
Don't worry. So, any question before we call it a day?
So that means if this WhatsApp is not working, we'll switch over to Telegram.
To Telegram, yes. If you look at it before our next class, if it does not come up, we switch to Telegram.
So that you send this class.
What do you say?
I get these notes today.
When I get to,
I'll send a message to you on Telegram.
no problem. No wala, you get it.
So come down, let me finish
On Telegram.
copying the.
Please just send it instead of that Telegram, because I will need to be putting this on my phone first before sending it to you. Just send me your email, please.
Okay, that will be fine. I was
Sir, come down.
That will be fine.
Sir, come down. No, not the main solution. Yeah.
So just send me your email on Telegram. I forward the note to you.
Sir, I don't know. This does it mean that any adjustment you make on the net operating profit, you do the same on the capital employed?
Yes. I told you now, it depends on the year now. Is there everything we did here is there everything we did on this one that is here?
Not everything.
Yeah.
Not everything, Sha.
It's the one that is applied to the year you are dealing with that will add there now.
Okay,
We
the
have one-
capital employed will be for the previous year.
Yes, now. That's what we said. That's why I first ask you, the money you use to start your business, where will you put the money? At the beginning of the year. So the capital employed must be capital employed for the last year. So any adjustment that affect that year is what we are going to treat there. If what we have here, research and development is here, do we treat it here? No, because we do have research and development in 2014. It's the one you have on this date that we will treat on that date. The one you have on this date, you also treat it on that date. That's all.
Okay, sir.
You understand?
Thank you, sir. Yes, sir.
Okay.
Thank you, sir.
Are you done with the notes?
Yes, sir.
Okay. So we meet in our next class. Agree. Mrs. Shew. Hello, Mrs. Shew. Are you still there?
Hello, sir.
Yeah. You need to put a call through to Mrs. Angela. Did you hear that she was kidnapped?
No.
That's why she has not been joining us. So she was kidnapped. They just released her on Thursday.
In this, where? Which state?
Imo State.
Imo State.
Imo State. Jesus. She's well.
So that's why she has not been joining us.
Hey, yeah, so sorry about. I'll call her.
No
I'll
problem.
try and give her a call. She's well.
All right, take care.
I need to say.